And the numbers aren't so great, are they? Just quickly, just got about 15, 20 seconds.
No, they are not. They are in, I believe, like the four figures at this point. If you exchange the crypto, they're into real money.
That includes the cents, right? No, I'm just kidding. Yeah, and you can read those numbers in the story. Hey, listen, Brian, thank you so much. Brian Feldman, he's freelance reporter at Bloomberg Business Week. Check out this story online at Bloomberg Business Week. And our thanks to Jill Weber, editor of Bloomberg Business Week magazine. You are listening and watching Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right. Hey, I don't know. It's a day in October. Maybe it's time for a management change. Not or management.
Restructuring.
Reorg.
Yeah, reorg.
Right? Fall, that's when you change things.
There have been a few reorgs recently, too.
Especially at Goldman Sachs. Yeah. All right, we're going to talk about that. Remember, it reports earnings tomorrow, so we'll get into that with our Sri Natarajan in just a moment. First up, though, let's get back to the markets and your top business stories. Here is once again Charlie Pellet.
Hi, thank you very much. We've got Goldman Sachs shares up now by 1.8%, part of a broad-based rally today. Now, the breadth of this rally is so strong that at one point, over 99% of companies in the S&P 500 index were higher. Right now, we're off session highs, but still substantial gains for the U.S. stock market. We've got the NASDAQ 100 index, the outperformer, up 3.4%. The NASDAQ Composite Index up now by 343 points, up 3.3%. S&P 500 Index up 92, a gain there of 2.6%. And the Dow is up 542, up by 1.8%. Stocks climbed after the S&P 500 breached a technical level that has triggered gains in the past, with risk appetite improving as more of UK Prime Minister Liz Truss's unfunded tax cuts were reversed. The 10-year yield 4.01% right now, the 2-year 4.45%. Spot gold up 0.4%, $16.50 the ounce. West Texas Intermediate crude down 0.4%, $85.32 a barrel. Well, as for the broader market and some advice for investors, Erin Brown is portfolio manager at PIMCO, and this morning she told us, yes, you gotta remain defensive.
I still think that there's significant challenges ahead as we turn the corner into early next year that the market hasn't digested yet. Earnings estimates are too high, margins expectations are too high, and I don't think that equities are still, singing from the same hymn book that we see in the fixed income markets.
CVS will not be pursuing a deal with Cano Health at this time. This according to Deal Reporter, citing sources. Cano is the healthcare provider backed by billionaire Barry Sternlicht. Cano shares plunging 39.3%, CVS up by 1.5%. After earnings this morning, Bank of America surging 6%. Coming up, we will have a conversation with CEO Brian Moynihan. And again, Goldman Sachs, which reports tomorrow, up 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So much going on when it comes to the big banks. And, of course, we had some more earnings this morning. They're all on our radar again. B of A shares rallying as loan revenue topped estimates. Also, net interest income up 24% to the highest level in at least a decade. You've got Goldman also higher. They're reporting earnings tomorrow. But we got some news that's going to combine its investment banking and trading business. And then there's some stuff on Credit Suisse. Oh, my God, I'm exhausted already.
Well, fortunately, we have Sri Natarajan here to help us out because he can report on all that and more. He's finance reporter for Bloomberg News. He's with us right now in the Bloomberg Interactive Broker Studio. Sri, I want to start with the Goldman story. Goldman shaking up its leadership ranks in yet another overhaul. What's the big headline here? What's the reorg? Who's taking over for these divisions?
I'll start with the last three words of that headline: yet another overhaul. And I feel, to some extent, that's more the news than actually what they're moving around. It's not the rearranging of the deck chairs, to be clear, without any iceberg in sight. But it is not about the changes itself, but the fact that it's happening again, because David Solomon, the CEO of Goldman Sachs, is 4 years into the top job at the Wall Street giant, and this is the third major restructuring he's undertaking. Not just that, with this move, he will be undoing a lot of the signature moves he put in place and changes he made just 2 years ago. That is not a good look, and that gives a little bit of whiplash to investors. So let me actually step in and tell you what the changes are. You have a Goldman Sachs with 4 distinct divisions: trading, investment banking, 2 units where their strength is, it's fair to say, unparalleled. Then they had this asset management business, which is the Goldman Sachs asset management business, investing in public markets on behalf of other investors, as well as this merchant bank, which was sort of their in-house private equity shop. And then the fourth pillar, which was actually created in 2020, was this consumer and wealth management business, because that catered to individual money. Some very, 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 very rich people and some average Joes. But those were all people that Goldman was targeting. They've wiped the slate clean. They've combined banking and trading in a way to try and showcase to the market that, hey, if you see banking and trading as one combined group, similar to how JP Morgan does it, similar to how Morgan Stanley does it, you may be able to appreciate how, well, I can't use the word, so how good it is. That's one goal with CIB. Then what they did, and we've talked about for a few months now, they've had major issues with their consumer business. They're effectively dismembering that, bringing back wealth management into their asset management business, shoving a part of their direct-to-consumer business, which operated under the Marcus brand name, into that unit. And then the third is this weirdly named business called Platform Solutions. It has such a McKinseyan ring to it. But it is taking their, the online loans provider that they bought last year, Green Sky, the credit card partnerships, which is the ones that they have with Apple and General Motors, and the transaction banking business, bringing it under one roof, having it as a standalone business. Think of it somewhat like embedded finance, which a lot of people are hot on, including McKinsey. Wow, I'm actually close on this McKinsey conspiracy theory. They might have been behind this name. To be clear, I do not know for sure.
I hear some reporting a little bit later on.
But it is a standalone business, and
Yeah.
it will be interesting to watch, because that business will report losses for the foreseeable future, for the next quarter or 2 or 3 or 4 or more. Not many Wall Street banks have a standalone division that where the P&L will be so visible and so painful. Goldman's got to hope that investors don't pay too much scary attention to it, are willing to cut them some slack, and actually see the new narrative that they're trying to spread.
Connection lost.
And believe in it.
What prompted this shift?
A number of things. First off, why this shift? Just in January, you did a massive change of the asset management leadership. In 2020, we just talked about all the other changes they made. But the mumbling and grumbling outside of Goldman Sachs had been clear for the better part of the last 6 months. They worried about the situation in the asset management group and how the new leadership is getting along. They really worried about the consumer business, which, as we've reported at mid-year, they projected would lose well more than $1.2 billion in a year when the bank's total earnings is expected to drop 40% from the fabulous success they had in 2021. That was just too harsh a spotlight on that business, so it was clear something had to be done. And it's fair to say that the problems with consumer accelerated some of the discussions they had about other reorgs. If you're bringing back asset and wealth management and making it this large one unit, you probably do the CIB aspect of it. The banking and trading combination is something people had been pushing for at the firm. David Solomon and his team had been reluctant about that, because they were more interested in steering investor attention towards asset management and consumer, those recurring fee businesses that they think investors will appreciate. Now that they've actually made this combined banking, global banking and markets group, perhaps it's an acknowledgement that maybe it is fair to shine the spotlight on their crown jewel, and maybe it will give them a boost with investors. That we don't know yet, and that we'll see over the coming months and quarters.
All right, well, an incredible story. And then ahead of course, Goldman has its earnings tomorrow. We're going to leave it on that note. Bloomberg News finance reporter Sri Natarajan in our Bloomberg Interactive Brokers studio. Shares of Goldman Sachs, by the way, they are up 2% in today's session. Another standout among the big banks, Bank of America, up more than 6% following its earnings report. Right now, we want to head over to our TV colleague and radio colleague, David Weston, who is sitting down with Bank of America CEO Brian Moynihan. Let's listen in.
From Bloomberg World Headquarters in New York, welcome to our TV and radio audiences worldwide. I'm David Weston. Bank of America reported its third quarter results today. Net interest income was the highest in at least a decade. Chairman and CEO Brian Moynihan saying U.S. consumer clients remain resilient. And Brian Moynihan himself, the chairman and CEO of Bank of America, joins us now. Brian, thank you so much for being with us. You've said the consumer is strong, continues to be strong. I think you said 10% up perhaps from what you saw in October. But how long can it last? You have some competitors saying by the middle of next year, they're going to run out of those balance sheets.
David, good to be with you again. So let's step back and talk about the different ways we talk about resiliency. First is, are the consumers spending? Are they doing things that drives the U.S. economy, as you well know? And so the spending for the third quarter was 10% higher than it was last year's third quarter. The spending for the first couple weeks in October is 10% higher than it was last October for the first 2 weeks. Now, what we told people was you're seeing it slow just a hair. So it was maybe 14, 15% early in the year, 12, and now 10, which is frankly what people are trying to do is get the spending down a little bit, get the inflationary pressures down and the drag of the interest rates, but it's still strong. And then, so that's one way to think about it. The other way to think about the consumers, do they have money in their accounts to spend? And in the month of September, the account balances were flat or slightly over where they were in August. And that is multiples of where they were pre-pandemic, and they continue to hold their own. And you can see inside the cash flow in customers, not making any reflection on this is tough on certain customers, others, but even when customers have lower income levels, we can see them cash flowing positive still. Rent increases could slow that down, other things could happen, but the core thing is, as of the third quarter, they continue to cash flow, and they continue to have more money in their accounts than they did before the pandemic by multiples. And then you go to their credit quality, and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit. And that's good news for America, but it also makes the Fed's job tougher because they're trying to slow down this American consumer, which is a very resilient thing.
But just to make sure I understand it, and obviously you can't promise what's going to happen next year. I'm not asking you to do that. But a lot of economists are saying the reason consumer is so strong right now is because the balance sheet were so strong coming out of the pandemic. At this point, you don't see those balance sheets really turning down as we get into next year.
We don't see it yet. And so if you look back 2 quarters ago when we did the earnings call, people are like, oh, the consumer is getting knocked out of the game, they're spending their accounts. 6 months later, the money's still there. So I think people are over-anticipating the future. We, as our projections, Canada Balance Plot, and the team in our research group, which is one of the best in the world, has the third quarter positive, the fourth quarter negative, the first quarter negative, the second quarter of 23 negative, the third quarter of 23 negative, albeit at like a 1 to 1.5% GDP annualized growth rate, negative growth rate. So we are predicting a shallow economy. That's our core assumptions. And embedded in that, if you look at how we set our reserves, we have the assumption that we're going to have 5.5% unemployment. I'm not sure that's going to happen, especially this quarter. We have it at 5%, but that's the conservatives when we build our balance sheet from an operating basis. But if you look at the consumers, there's not the signs that we see in our numbers or other people's numbers, quite frankly. It says they're slowing down yet or they're in stress yet. And that will have to be part of what happens in order for there to be a deep recession, because if the consumers have money in this big consumer-driven economy, that's what keeps America strong.
Brian, you've always taken great pride in the Bank of America research unit and how good they are. Let's assume their numbers are exactly right. It could be better, could be worse, exactly right. 3 down quarters, 5.5% unemployment. What does that do for your loan loss provisions? What kind of provisions do you have to make for that?
Well, inherently, we're always discounting the future because the way the CECL rules work, so-called, you look out for the life of loans. So you build reserves, and we built $400 million or so this quarter, which is building that scenario, which is 60% to the base case, which is the average of blue chip economists, and 40% to an adverse case. And when you blend that together, it implies those adverse cases have high inflation and have high unemployment in them. And you blend it together, the core, what we did at the end of the third quarter, has 5% unemployment for the fourth quarter of 22 and more than like 5.5 for next year. So it's very conservatively built. So your provisions will go up against that backdrop. At one point, you'll start to see the other side of it emerge, and that's what sort of happened back in the pandemic. We put up a lot of reserves, and we took them back in once you saw that the impact of, because what the administration did and what Congress did and what central banks did around the world, you actually mitigated the effects of the unemployment numbers. That won't happen in a standard recession, I would expect. But on the other hand, the consumers are going in much stronger shape than they did even in 2006-07, leading into the great financial crisis.
Brian, throughout your tenure, as far as I can tell, you've really embraced what you call responsible growth. We know what it's looked like in the last few years. What does responsible growth look like for Bank of America in the next 4 quarters? Just take 4 quarters.
Well, we continue to look for deposits to basically outgrow the industry, and the industry is predicted to go down to flat, and we will be in that range because, frankly, the monetary accommodation we draw. And we look at loans to grow in the mid-single digits. They grew a little faster year over year. Then we slowed down a little bit because of some of the capital changes that occurred in the third quarter, which we've taken care of and put in the rearview mirror. So we sort of look at that. But the key about responsible growth is people forget it's not only the growth, it's also how we get there with our operational excellence platform, which allows us to drive expenses. The work we do in OpEx continues to fructify into further and further gains for us, so that we had 3 quarters in a row of flat expenses while the revenue kicked up, and that's where you see the margins kick in, and our efficiency ratio is down in low 60s and moving south from there. Those are good things, but that comes from hard work beyond just can we get growth. It's how we run this company, and the team's done a great job doing that.
So, Brian, again, you've prided yourself in really carefully blocking and tackling on the expense front, and you've gotten a lot of credit for that. What does that say about employment in the scenario that you're laying out? You could have cuts, but even apart from cuts, maybe through attrition, do you expect your payroll to diminish?
We don't expect the payroll to diminish. We don't expect the headcount to move much. We're running a company today in 2022 at the same number of employees who ran the company in 2015, round numbers. What those employees do is change dramatically across. That's 7 years, David, so it's not a short time. And so we've redeployed those employees more towards generating good work for our customers and our clients and better experience for them, and taking them out of work that we engineer out of the system through the digitization and work we do by our customers and by ourselves. And we'd expect that to continue, sort of relatively flat head count, but there's a massive change that goes on underneath that. So we added 1,000 people in our investment banking team over the last 12, 18 months, and we're going to keep those teammates and keep driving because we're number 3 market share, and we think we can get more if we keep deploying people out to go see those great clients we have. So we don't need to drop expenses. We're running basically at a level that our company feels strong at and good profit margins. And you have natural adjustments that go on when markets go up and down based on bonuses and stuff, but that's not the core case. The 213,000 or so teammates we have here are doing a great job, and our job is to keep employed. Can we manage the headcount up or down? Sure. Headcount, by the attrition that goes on, you can always manage it down. But right now, we're kind of flat. We expect to maintain flat. Now, remember, we had to hire like 5,000, 6,000, 7,000 people this past quarter, third quarter 22, to keep that headcount basically up a little bit. So our teammates who leave us go to great jobs other places. We've trained them well. We'd rather for them to stay, and our attrition's coming down. But when they don't, that doesn't mean they're going to sit on the bench. They're actually going out there to work for someone else, and we bring more teammates in and do a great job with them.
Brian, I know one of the things you've paid a lot of attention to, you and your team, I should say, is value at risk. Tell us about trading value at risk. How are you going to be managing that through, even under your projections of a shallow recession? It's still going to be a bumpy ride.
Well, let's just start with the backdrop. Jimmy DeMar and the team did a great job this quarter and had the strongest third quarter in 2022 they've had since 2010 in trading. And so fixed income rose. The investments we made in the balance sheet and the talent in that business over the last 3 or 4 years bared fruit, starting under Tom Montag and now under Jimmy. The second thing is, the way they manage risk, they didn't have a trading loss day the whole quarter in a very volatile quarter, and that's how they manage risk. Our job is to move the risk from the market to the client, and to the client back to the market, and we're in a moving game, not the storage game. And value at risk has gone up because of the volatility in the calculations, but it's still way below probably 25% of where it was at the volatile times back coming out of the financial crisis. And the balance sheet's strong, and Jimmy and the team has done a good job. We'll continue to manage that. We continue to watch how much risk they put on. They make judgments every day, but they have risk-weighted assets and VAR limits, and the VAR limits by desk, and they manage all that for us. But it doesn't constrain their ability to do good business. But you got to start from the basic principle. We're not in this business to pull a lot of that risk in the markets business on our balance sheet. Our job is to move it through the system.
Talk about a couple of specific areas. One of them, leveraged loans. There seems to be some stress in the leveraged loan area right now. How do you assess the risk in that business? Are you going to be retrenching?
Well, there's a natural retrenching that went on because the market stopped. When the spreads went out and the cost of debt became so expensive, the deals are harder to get done. So that's what happened. So that stopped, I don't know, 3 or 4 months ago, probably, maybe even 6. And so what's happened now is we're working through the pipeline existed then. Those marks went through the P&L. We mark it every week based on the analytics going through every deal. It was less this quarter than the quarter before, and it's through the system. To restart that market, you got to get the stability, and you got to get the pricing stability, and you got to get the lending capacity stability, i.e. how many debt turns you can do and things like that. And then that market can restart. And it's not ready. It's still bouncing around too much for that. We got to let that play through. But in the end of the day, we look at those credits and make sure we understand the credit risk. And what's happening now is the price is blown out. Therefore, there's marks in them more than there is an underlying credit. Some of those deals are structured very well, and that's how we drive responsible growth. But on the other hand, the restart of that market's going to take a little bit till there's some stability in the spreads and the pricing and the economy and the risk around the economy, because that market really is driven by people's perceptions of near-term risk.
Brian, as you know well, there's a lot of concern, given the stress domestically and particularly internationally, on whether there could be market disruptions. In fact, one of the things that I've read a lot about is a real reduction in the liquidity in the U.S. Treasury market. Are you seeing that, and what are the risks that poses?
We assume market disruption. So what happened in the UK a week or so ago, we just assume that's going to happen. And the challenge is to be balanced and have your risk managed well and have your risk kept and not lean the company and lean the book too far either way, because then you get caught. And so we expect those market disruptions. There are issues because of the rules that were put upon our peer institutions and our institution that have constrained liquidity, and they look at those rules and they've waived those rules in times of stress. I think they need to look more carefully at them. They know that to make sure that things like treasuries have no risk, that market can stay open and wide and deep every day, and it bumps around every once in a while because of people's views of really spreads and rates. It has nothing to do with the credit risk, and I think we believe that some of that stuff shouldn't be counted the way it is, so we can be more active in intermediating those markets. But if these are the rules, we got to play by them.
Well, that's exactly what I want to ask about. Are there some regulatory things that we've done that could alleviate that? There's the Basel III, as I understand, is coming up. There may be increases reserves there. On the other hand, there's also the supplemental leverage ratio that was suspended for the pandemic, then brought back in. Should they be considering doing something to sort of increase the liquidity in treasuries?
I think the SLR relief at a time of stress when they needed the banks to be strong sort of proves the point, is that they may not have it calibrated, but they're looking at all that. In the end of the day, our supplementary leverage ratio for our company is very strong, very far over the minimums, and it's tens of billions of dollars of capital in excess of what's required. So we're there to do it. It's just that you want that market to be, that is the market the world benchmarks off. We got to keep it open and deep and trading and liquid, because that is the market where everything else plays off. When there's disruptions in that market, it reverberates throughout the world, and that's what we don't need to do. As we raise rates, we're causing reverberations in the world. We don't need a liquidity reverberation on top of that. So we advocate as an industry a lot that they ought to look at that and think about whether there's any real risk there, and let us intermediate a little more fully.
Brian, you referred to what happened with the Bank of England and the British government, for that matter, involving those pension plans and long-term gilts, as I understand it. And you said we have to expect something like that could happen. My understanding is often it happens in the dark corners that we don't know as much about, and often it's a matter of leverage. Where do we have the most leverage in the system right now, and particularly in darker places?
Well, as we've made clear over the last several years, the banking industry continues to be well managed by the management of the company and the teammates that work for these companies, well regulated, capital levels up, liquidity and all these different rules managed in all the different ways looked at, active forceful stress testing done once a year by the Federal Reserve and multiple times during the year by the companies. And so you put all that together, it's a pretty strong framework. The problem is what's outside the system. And so if you look at some of the advocacy that we make as a group, as banks, is half of every lending asset class is now outside the system. So the amount of leverage can go on in the unregulated industries may or may not be consistent. Now, the good news is most of that's in what they call net asset value. In other words, that if the asset goes down, the amount they owe the investor goes down. So it kind of a deposit, which is fixed at $1 on the other side, but it's not always true, and some of that leverage can hurt. So I think if you look at the banking system where it's leverage credit, for years we've kept limitations on how much leverage and debt turns. The SNC process, the Shared National Credit process, the examinations by the regulators kind of keeps the banking system in line. Outside is the worries, and you saw the FSOC and others kind of think about that and talk about that, and we advocate that we need that, because at the end of the day, it affects our system even if it's done outside it.
For our Bloomberg television and radio audiences worldwide, we are talking with the Bank of America Chair and CEO Brian Moynihan. Brian, tell me about your customers and how badly they're suffering from inflation as you talk to them, because you talk to a lot of them, not just the big guys, but the medium and the smaller guys. How badly are they hurting because of inflation?
Well, the inflation's one thing, but also the rate structure that was moved to countervail the inflation. So it doesn't take a perspicacious analyst to realize that when you raise rates, people are going to have a harder time borrowing and things. So if you look at the mortgage market, for example, the increase in mortgages has lowered the number of mortgages that are getting done. Our production, I think, was $8 billion this quarter versus 20-odd billion last year this time. So you start to see that impact. And what that really reflects is refinancing on one side, but also home purchases and the ability to qualify. So you're seeing that. You're seeing the impact start to come through the rental market to match the increases that landlords will feel in the debt financing to refinance their buildings and do their buildings, although they're locked in. And people have to remember that a lot of this debt is now locked in for long periods of time under prior rate structures, both at the consumer level. Half our mortgages are under 3 and 80% are under 4 or something like that. So that's locked in very strongly. But on the other hand, those rising rates have that impact, and the stress occurs, and ability to qualify for mortgage credit and auto credit. Those are the sort of fastest moving changes. And then the cards move a little bit, but not that much, frankly, in the grand scheme of things. But you see it sort of move through those areas. And then on the business side, as you know, the base rates move up, so for LIBOR, et cetera, and BSBY and things like that, you see the spread put on top of that. That'll slow down activity because the cost of debt just becomes higher. That's how you slow down the economy. That is the expected outcome. That is what the Fed's trying to achieve, is bringing down the economy. And the question is, can it be landed right? But on the other hand, you're seeing exactly what you expect, which is the conservatism built in terms of inventories cost you more to carry. In terms of buying a building will cost you more to finance. On the business side, you're seeing that, and you're seeing line usage come down a little bit because people are using the cash a little more aggressively, because if they can avoid borrowing, it saves, at this point, a couple hundred basis points over these spreads is a fairly sizable number.
Brian, one last one. Let's come back to the consumer where we started. You said that your anticipation for Bank of America is to grow deposits at better than the market. Does that say anything about savings rates for households across the country? Are you expecting those to remain solid or even pick up?
Well, as we look, we reached a record number of investors on our Merrill Edge platform, our sort of general platform, not Merrill and the private bank, which are in the wealth management business, the 3.4 million. We had I think 100,000 new accounts open this year or something like that, net new accounts this quarter or this year. You're seeing people continue to invest because people should be investing for the future. I just we have our employees in that have 50-year milestones, 55, 60, and 175 years working for the company today to celebrate them. And I was looking at the write-up of one of the teammates, and he started in the business, the Dow was at 500. So the idea is for people to be invested and invest over time, and there'll be ups and downs, but if you stay with this great American economy, these great American companies, you'll be fine. So our job is to help people invest in the future. The savings rate and how people spend, you'd expect spending to slow down a little bit. You saw that a little bit because people are going to be more conservative. The inflation makes the dollar they spend not go as far. Those are real issues, but that's the intended outcome of trying to slow down the economy with higher rates and deal with inflation to bring it back under control so real wage growth starts to happen. Those are the things the Fed's doing, but if you really think about it, our advice to our customers is, stay invested the right way, look for quality companies, and Andy and Katie and Chris Hayes in the world, but don't be afraid of any environment. And yeah, there might be more opportunities in treasuries now than there was a year ago, but that's life, and that ebbs and flows, but you got to keep saving your money and invest for your future.
There's the advice we're looking for. Thank you so much, Brian. Really appreciate your time. That's Bank of America Chair and CEO Brian Moynihan. And now, back to you.
What a great interview, David Weston. We thank you. And of course, this is Countdown to the Close with a little more than 60 minutes left in our trading session. Caroline Hyde, Romaine Bostick, and Taylor Riggs. I'm pleased to say we're joined now by our colleagues, Carol Massa, Tim Stenovic, as we go across audience, TV, radio, YouTube, to think about where people are putting their money. Is it cash? Is it, gilts and US Treasuries, as we're hearing from Brian Moynihan? Or is it just everything, as it seems to be on the day, Carol?
It does seem so broad-based, and we're certainly seeing, as you said, investors finding lots of opportunities throughout the financial markets today. One thing that I've also been thinking about everything we got out of China this past weekend, and we're seeing investors buy up some of those Chinese names, the NASDAQ Golden Dragon, up about 3.5% here. So we're seeing some market outperformance, and it's interesting because we did get from President Xi, concerns about COVID still and concerns about geopolitical tensions, but nonetheless, we did also have Chinese regulators talk about ramping up efforts to support the stock market, and so we have seen investors, certainly here in the U.S., come into that in a big way.
Yeah, I was mostly interested just now to hear what Brian Moynihan of Bank of America had to say about the American consumer. A lot of strong signals, essentially not seeing spending come down to the extent that many would have thought, given high prices and the fact that many have argued over the last few months we're heading into a recession. But, I mean, those comments not hurting the rally that we're seeing today.
I mean, rally that Bank of America is large part benefiting from on the day. We're seeing, of course, some of the banks doing particularly well. Let's look at the majors overall, because S&P 500 is on the higher side overall, up by 2.65%. We're up 3.4% on the NASDAQ. Actually, volume's a little bit more muted than we're used to, but we're up more than 1.8% on the Dow. And look at that, Russell 2000. Even the small cap's getting a bid. Taylor, something you were keeping an eye on.
Yeah, we've heard a lot about this, about a small cap rebound that is leading the way. We'll get into that in a little bit more. Remain, at least for now, on the large caps in S&P 500. Some huge breadth, if I will. Every sector in the green, discretionary, big outperformer. Real estate actually catches the bid, given bond yields are falling. Down at the bottom, energy, which you typically don't see, but it is still up about 1.5%.
Yeah, you talk about some of the big cap tech names that are helping to lift this stock, lift the market higher here on the day. Apple up about 3%, Nvidia up almost 6% here on the day. Most of the tech stocks, in fact, are really getting in on the action. Semiconductor stocks, I should say. Meanwhile, you only got about 20 stocks in the S&P 500 that are lower. One of those is Charles Schwab. Interesting earnings report. Some of the top line numbers actually met or exceeded expectations, but some concerns here about cash and the balance sheet, and kind of more importantly, sort of how that's all being sorted out on that balance sheet. Those shares down about 2% on the day, but probably one of the biggest losers, at least on a percentage basis, that belongs to Cano Health, down about 39% right now. There was a lot of M&A speculation around this stock over the past couple of weeks. CVS, there was a report out earlier today from people familiar with the matter saying that CVS was not going to pursue an M&A deal with Cano Health, and then CVS did come out with a statement saying that they're not willing to comment on that. Nevertheless, investors taking that as a sign that maybe a deal isn't quite in the works.
And despite the best efforts of Cano Health to go lower, we are still seeing the markets go higher, but maybe we're starting to see that buy the dip mentality. The Morgan Stanleys of this world, the Mike Wilsons saying, look, maybe we could have a bear market rally, as we have seen people getting more and more pessimistic. The strategists in general have been lowering their expectation of where the S&P is going to end the year. We're down nearly 7% in the last month in terms of the outlook from strategists. Largest drop in at least 7 months. Shout out to Pete Dieterres for this one.
Love that chart. That pessimism, maybe that's going to make sense with this next individual. He's been a long-time market watcher. We're talking about Mark Mobius, invests around the globe, founding partner of his own firm, Mobius Capital. But he talked about basically how extreme it could get when it comes to interest rates. Here's what he had to say.
Anybody sitting on debts, high debts, are going to be in trouble because of the higher interest rates. I see interest rates in America going to 9% because the Fed is going to have to keep on raising rates 9, simply because if inflation is 8%, the playbook says you've got to raise rates higher than inflation, which means 9%. Of course, that theory will go out the window if CPI goes down, but I don't see that happening anytime soon.
And of course, that's Mark Mobius of Mobius Capital Partners. And you do think about how persistent, we got that in the U.S. readings remain last week in terms of inflation. So how persistent it is, it's not coming down. And you do wonder how far the Fed is going to have to do to start turning the corner when it comes to inflation.
Yeah, and that gets us back to the whole debate about that terminal rate. And I mean, in fairness to that comment there, I mean, you have actually seen some softening in certain areas that the Fed pays attention to. And of course, it's not just the differential between that headline 8% number. Probably better is to go off the base of that PCE number, but still, his point is taken. You have to get the terminal rate, in theory, above where inflation is, or at least somewhere to match it, sort of the two ships passing in the night. And we're definitely not there, probably a long way away from being there.
And then what does that mean for, well, discounting of what your value of equities is? What does that mean for growth stocks? The fact that we've got so many of these earnings coming from a number of the growth stocks. Netflix has been on a tear of late. We've got Netflix later in the week, we've got Tesla. What is the underlying performance of these companies, weathering inflation within their own companies and being able to pass it on?
Dan Ives over Wedbush saying that this is going to be the crucial season, Tim, when you think about those companies, at least within big tech that Caroline was just talking about, who really can manage those cash flows and do well. And then again, those who are really maybe sort of more tied to the macroeconomic slowdown and the impact that that has on them. Overall, though, too, there's been a big focus on some of the small caps. And Romain, there's a really interesting note talking about how small caps are some of the biggest discounts they've had to the S&P 500, the small cap 600 index, at least by one measure.
Right.
The bottom 5th percentile, I think it was. So at least on some measures, there are pockets that look attractive.
I saw that same note, and of course, historically we know there's something, Taylor, we call the value trap, and the question is, if you sort of pile back into some of those cyclical names based solely on valuation, then are you setting yourself up for that? Now, if you genuinely believe that the cycle is turning here and that we are sort of past the worst case scenarios with regards to recession and economic downturn, then yeah, it makes sense.
Well, Goldman Sachs out with a note also that says there are some value plays to be found in some of the tech growth stocks that have gotten beat up this year, including companies like Meta Platforms. At the same time, even though the S&P 500 is down what, roughly a quarter so far this year, they're still saying the index on a level is still too expensive to buy.
Gotta say, think about what Gina Martin Adams has laid out for all of us. Third quarter earnings expectations have come down, way down from what we saw over the summer. I think we were looking for about 10% growth on the third quarter. It's now down to 2%. So, the thinking is the bar is so low when it comes to earnings, so that any beat, how will investors read it? Will they see that as optimism? Will they understand kind of the economic outlook? Got to kind of think about that as we parse through the numbers.
Is it 19 straight weeks now of revisions, the Citi index of revisions, going more downgrades than upgrades? What's already being priced in, but many, like Mark Haefele over at UBS, was saying it's not yet priced in if you're looking at valuations.
But that's why I'm curious. I mean, is the bar really that low? I mean, I think for certain companies, you can definitely make that case, but for the market as a whole, I think some would argue that maybe the bar hasn't come down enough. And to your point too, Taylor, what you were just talking about, I mean, just because something's cheap doesn't mean there's value.
Some people say
there's a
reason.
For a reason. Yeah, there's a reason why it's cheap.
Small cap because it never has the ability to grow and to be big. So we hear you loud and clear, but I'll keep pushing for the small caps. At least 3 of the notes I've read are pushing for them.
Okay. Hey, I want to go back to something that Brian Moynihan said during that interview that he just did with David Weston. This was shocking to me. Half of mortgage rates that they have are under 3%. 80% of them are under 4%. What does that mean for the housing market? People are not going to get up and move because then they're going to give up that incredibly low mortgage rate that perhaps they're not going to see for years. What does that do to the housing market?
Well, what's interesting is it just shows that some of the Fed policy already obviously having an impact, and we're seeing that play out. But you do wonder about, right, if you're not moving around, you're not buying new stuff for new homes, it certainly brings down economic momentum. How did we not mention BTS, guys? I'm just asking.
Wait, they're all going to the Army or something, right? Yeah.
All right.
Well, that's good. I mean, for the Army.
Yeah. Anyway. All right.
They're popular,
I needed
right?
some levity.
Who's going to touch them? They're too pretty to go to war.
They're going, Romaine.
You'd think they would get an exemption.
I know. Apparently they're not.
For all the joy that they've brought us over the years.
I know. They're fun.
Now, maybe that's time for a new recruits to come.
Yeah.
BTS.
They can start.
What about Blackpink? Do they have to go too?
All right, we're going to get yelled at. We got to go. All right, we will be back in less than an hour.
Just
asking. We'll ponder that and then come back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, Beyond the Bell. We're going to count you down to the close on this Monday.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So a lot to really think about. Interesting interview from Brian Moynihan by our David Weston, of course, the CEO of Bank of America, out with earnings, very upbeat in terms of consumers. So it's interesting to hear what the big banks have to say. I do also wonder when we hear from the big banks, important in understanding financial markets and how things are going, how indicative, though, is it of the broader economy?
Here's some quotes from that. The consumer is strong. There aren't the signs in our numbers or anyone else's numbers that the consumers, are slowing down or that they're stressed. Brian Moynihan saying that he doesn't see balance sheet turning down, quote, yet at this point.
Yeah, but that's good, right?
It's really good.
When we think about financial market structures and credit stress and so on and so forth. So I do think that is certainly significant. What did he say? Credit quality is strong while delinquencies are low. Shallow economy, those signs don't show stress. So these are important indicators. And as we continue to watch it, we're just getting going when it comes to earnings. And so
we got Netflix.
Got to hear from more.
We got to hear from Apple. We got to hear from Tesla. We're just getting started. I mean, I think only 60 companies in the S&P report this week.
I want to hear from those companies in the consumer space. What are we seeing when it comes to consumer spending? So lots more with that. All right, let's get a check on world and national news. For that, it's over to Ann Mostu in our Bloomberg newsroom.
Thanks, Carol. Relying on Iranian arms, Russia has attacked Kyiv with drones. The strikes highlight Russia's growing use of Iranian-made drones, as Western analysts say Moscow's stocks of precision missiles are running low. Federal prosecutors in the U.S. are recommending 6 months of jail time for former Trump advisor Steve Bannon. This comes after he was convicted of contempt of Congress after refusing to comply with the subpoena from the committee investigating last year's Capitol attack. Bannon would not testify or turn over documents to the panel. UK Chancellor Jeremy Hunt has ripped up almost all of what was left of Prime Minister Liz Truss's economic program. Bloomberg's Lizzie Burden has more from Westminster.
He's absolutely nuked Trussonomics. He's reversed most of Truss's tax cuts. He's limited the energy bailout that she was always taunting the opposition Labour leader Keir Starmer with, that her package was bigger than his. Now it's going to be reviewed in April to try and save the government some money. A huge humiliation for Truss.
That's Bloomberg's Lizzie Burden. Halloween candy prices are getting a little scarier this year. According to the Bureau of Labor Statistics, shoppers can expect to pay about $2 more for a typical large bag of Halloween candy. It's the biggest yearly jump in candy prices that the CPI has ever recorded. And tonight at 7:07, it's Game 5. New York Yankees face the Cleveland Guardians at Yankee Stadium. The winner heads to Houston for Game 1 of the best-of-7 AL Championship Series on Wednesday night against the Astros. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ann Mostu. This is Bloomberg.
All right, Ann, thank you so much. Ann Mostu there with our World and National News update. So we're going to dig into what was, safe to say, one of the big stories, too, certainly overnight, over the weekend. A lot of news coming out of China. President Xi making some comments. So where do you want to begin?
I want to start with the COVID-0 policy and the fact that it's still leading to lockdowns. And we're not just talking lockdowns of small areas. I mean, maybe small relative to China's huge cities.
Yeah.
But there's now an area being locked down in China of almost 1 million people near an iPhone factory. It's the iPhone manufacturing hub of Zhengzhou. It's locking down one of its most populated districts to tame a virus flare-up, with creeping restrictions throughout China underscoring the constant threat of disruption that companies face while the country sticks to COVID-0.
I mean, this is the sticky part of China in terms of trying to figure out what happens. I mean, their economy is looking at, the slowest growth in a long time, and we're going to talk about that with our Eric Schatzker in just a moment at Bloomberg New Economy. But a big reason why is these constant and chronic COVID lockdowns.
Well, here's what led to it, Carol. 6 new local cases for Sunday in the city, down from a recent peak of 40 on October 9th. Nationwide, cases declined to 697, the lowest in 2 weeks, as outbreaks in Inner Mongolia and Xinjiang came under control. Beijing posted 13 new cases, and Shanghai had 32. I don't know how this ends in terms of COVID-0, because I think what we've learned over the last 2 years is, is it possible?
Yeah, I don't know. I think at one point we lauded it, like this whole idea of saying you got to have no cases. And as we have vaccines and boosters, you need to, I don't know, I guess I think the thinking is certainly within our country, it's a different thought process.
Well, look what it does to economic activity. Look what it does to companies saying, we want to get out of there because we need to be somewhere that isn't disrupted by this. We're going to go produce, X, Y, or Z in another country.
Yeah, and I mean, the policy that you're seeing in China has definitely impacted their growth going forward. We're going to talk about that. We're going to talk about bans on U.S. talent at China chip firms. We're talking about geopolitical tensions. We're going to get into what you need to know about China. That's coming up next, right here on Bloomberg Business Week.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ all rallying, holding on to most of their gains. 43 minutes to go ahead of the closing bell. Let's get the latest on today's big events as we head right over to the First Word breaking news desk for today's afternoon call. And here is Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks with a bid from the start today, with the Dow currently up 542 points. S&P's gained 94, and NASDAQ is trading higher by 3.3%. The U.S. 10-year yield at 4%. Gold is up 5. Energy is in the red. And Bitcoin is trading higher by 0.9%. Among the main 11 S&P sectors, all were in the green, led by gains in consumer discretionary and real estate. And leaders to the upside in the Dow: J.P. Morgan, Microsoft, and American Express. Fractional losses for Walgreens. After earnings, Bank of America rose 6%. Bank of New York gained 5%. And in other news, Visa and MasterCard draw FTC scrutiny over debit card routing. In deal news, Dear Reporter said that CVS Health is not pursuing a Cano Health deal. Cano Health is down 39%. And wrapping things up, J&J and Goldman Sachs report tomorrow in the pre-market. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you, Bill. And to hear live breaking news over your Bloomberg, type Squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Carol Master, Tim Stenovic, live here in our Interactive Brokers studio, streaming on YouTube. And we want to talk about, well, we've been talking about the Chinese markets. We see Chinese ADRs trading up. This on news that Chinese regulators are ramping up efforts to support the stock market. You've got a lot going on, a lot of news flow out of China generally, and what is one of the key economies of our time.
Yeah, very busy weekend as President Xi reaffirmed policies at the center of frictions with the U.S. He spent 2 hours hitting back. It was opened in this crucial party gathering. We got Eric Schatzker with us. He's editorial director for Bloomberg New Economy. He's with us right now in the Bloomberg Interactive Brokers studio. So, Eric, before we went to you, we talked a little bit about what happened over the weekend in China. We also talked a little bit about another lockdown of more than 1 million people in China. And I'm thinking to myself, in a country the size of China that has a policy for COVID-0 that we already know has affected the country's economy so much, how does something like this actually end? I mean, how do we go back to a China that isn't increasingly isolating itself from the rest of the world?
It's an excellent question. As far as COVID goes, and you'll hear me say this word again and again and again, it's all about control, right? Demonstrating that the Chinese political model is superior to the model that we practice here in the West, where we had COVID restrictions initially, but eventually recognized that the economy had to reopen because we operate a democratic society where people's free will counts for something. It's consistent with what we heard from President Xi over the weekend. What he talked about, or let me say this, his commentary pointed to a China that on the one hand is more geopolitically assertive, but on the other hand is more economically isolated and less of a trading partner to the rest of the world. Again, because of control. He, and I'm sure you've been talking about the response in his speech to the U.S. ban on exports of advanced semiconductors and related equipment. He talked about winning the battle in key core technologies and moving faster and achieving technology self-reliance. But the challenge for President Xi and for China is that he envisions this being done within a political framework that prioritizes, above all, ideological rectitude, national security, and party control. There's that control word again. This is not the China that evolved into something resembling capitalism, right? In the 3 decades really, then plus that followed, Deng Xiaoping's reforms back in 1978. For the past at least 5 years, if not more, President Xi has been growing suspicious of market forces and the threats that they present to political stability, and the perceived threat that he feels, or felt anyway, and may no longer feel because he's put them in a box, from tycoons like Jack Ma and Pony Ma.
So how do we need to think, I think, about our audience, the investing audience? How do we need to think about China going forward? For so many years, right? For so long, it was all about global multinationals looking to get into China, have access to that market. So what is it going forward?
Well, China will be more inwardly focused, and those who were counting on sheet a reverse course and increase access may find themselves disappointed. I will emphasize that it is awfully hard to make anything that sounds like a prediction. First of all, you know, he hasn't yet secured his third term as president. The Communist Party Congress doesn't end until the 22nd of this month. It still has a few days to run.
But it's expected.
Yes, yes, yes. It's widely baked into the cake. But if he insists that Chinese scientific advances and innovation need to fall under the umbrella of state control, which is to say largely done by or directed by state-owned enterprises, it will look very different from what we know in the West and what China was increasingly looking like, which was a somewhat centrally planned but nevertheless still capitalist economy. And if you take that to its logical conclusion, to me anyway, it begins to sound a lot like the Soviet Union. And it's not to say that the Soviet Union didn't have brilliant scientists and didn't achieve great things technologically. It did. If you think about the things that the Soviets did with their space program, if you think about the things that the Soviets did militarily, like develop fighters like the MiG-25 and the MiG-29 that were every bit as competitive with what the United States and Europe could produce, and in many cases better, but ultimately not sustainable technologically and not sustainable politically. And I don't need to remind everybody what happened in 1989.
But Eric, in the last 30 seconds that we have with you, given that pretty much every single American company wants access to China, does that...
Still,
does that portend potentially a different ending?
It does. What they see there is 1.4 billion people to whom they want to sell things. You know, that's a very naked commercial instinct, but you know, if you're a shareholder of a company that's looking to grow revenue and grow earnings, it's logical. But bit by bit by bit, you have to ask yourself, if you're the CEO or the board of that company, is this viable over the long run, given what we keep hearing out of President Xi?
Because it does seem like the risks continue to increase. Bloomberg New Economy Editorial Director Eric Schatzker here in our Interactive Broker Studio. Eric, thanks.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening and watching Bloomberg Business Week on this Monday. Why does it already feel like Thursday?
Because I don't know.
I'm just saying.
That's not a good sign, Carol. It's not a good sign.
Coming up, we're going to get into a most read on the Bloomberg. It's really fascinating about the one market that dip buyers are wagering on in terms of leading us out of this market turmoil.
We'll be joined by senior markets editor Ed Harrison in just a minute. First up, though, Charlie Pellet, we got less than a half hour to go.
Indeed, 28 minutes to be precise, Tim. The Dow, the S&P, NASDAQ, they're all pushing higher. Stocks climbing after the S&P 500 breached a technical level that has triggered gains in the past. Risk appetite improving as more of UK Prime Minister Liz Truss's unfunded tax cuts were reversed. Now, the breadth of this rally is so strong that at one point we had 99% of companies in the S&P pushing higher. So here's where we stand. We've got the S&P up 97, close to session highs right now. That is a gain of 2.7%. The Dow up 585, up by 2%. NASDAQ up 355. That is a gain right now of about 3.5%. 10-year yield 4.01%. The 2-year yield 4.45%. Spot gold up 0.3%. $16.49 the ounce, while West Texas Intermediate crude is down 0.3%. $85.40 a barrel. Bank of America shares are surging 6.6%. It reported its highest quarterly net interest income in at least a decade as the lender reaps the benefits of the Federal Reserve's interest rate hikes, and debt traders beat analyst estimates. Allison Williams is a senior analyst for global banks at Bloomberg Intelligence.
The story for the quarter was very strong at the bank, and there's upside to the fourth quarter. So that's the good news. The consumer is healthy. And so now that we have, sort of the four biggest diversified banks coming in, charge-offs came in better than expected. That's current credit trends. So the banks did set aside some money for the future, but I would say, generally modest compared to some concerns.
And again, Bank of America up now by 6.6%. Goldman Sachs reports tomorrow. Goldman up now by 2.1%. Sources tell Bloomberg Credit Suisse is considering a sale of its U.S. asset management business. Recapping, 10-year yield 4.01%. S&P up 99, up 2.8%. Very close to the day's best levels. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So as we mentioned, the next thing we want to get into, it's the most read on the Bloomberg terminal today. It's about how investors are looking beyond a looming global recession, and they see one country and its financial markets emerging strongest on the other side.
We're talking about U.S. stocks and bonds leading the way out of the current wave of market turmoil. This, according to respondents in the latest MLive Pulse survey. We've got Ed Harrison now, senior markets editor at Bloomberg News, joining us on the phone from Washington, D.C. Ed, good to have you with us this afternoon. What else did we learn from the MLive Pulse survey?
Yeah, Tim, it was very interesting. I think what we learned was not only do investors think that U.S. stocks and bonds will do better on the backside of global turmoil or recession, but that the U.S. will emerge first from that recession, which is largely, I would imagine, one of the reasons that those shares will do the best.
Well, dig a little bit into, first of all, for folks who aren't familiar, we always are checking out your Pulse surveys that you guys do. Tell us give us a little bit of background about what they are, who you talk to.
Yeah, so we talk to a mix of institutional and retail investors, and we ask them a series of questions on one topic at a specific time per week. And this week, we were looking at asset markets and recession. And we wanted to determine, how were the markets doing, which countries are going to go into recession first between the U.S., the U.K., and the EU, who's going to emerge first, what's the central bank response in all of this, and then how do the asset classes do, both stocks and bonds, in those various countries. And in this particular survey, we got about 452 respondents, and 47% of those respondents expect the UK to win the unwelcome prize of going into recession first. An equal number, for almost the exact same amount, 45%, said that Europe would go into recession first, and only 7% of the respondents said that they thought the U.S. was going to enter a recession first. Likely meaning that the U.S. is not in a recession right now.
I'm wondering, Edward, what you can tell us about positioning as a result of this survey, because if this survey reflects positioning that institutional investors are doing, does it become some sort of self-fulfilling prophecy here? Because they're essentially voting their book, right?
Right. Yeah, I think that we have to look at earnings and stocks, and then also look at rates and bonds. In terms of the Fed. Okay. So on the stock side of things, the earnings are definitely going to play a key role in terms of whether or not you want to dip a toe or wade into that, given what you see going on. Because oftentimes earnings continue to dip into the recession, and stocks don't bottom until the middle of the recession. And so if you were to dip a toe in now, you would actually, be going into a potential. Whereas with
wait, say that again. Sorry, your line cut out. Will you possibly be going into a potential what?
A potentially losing position. Okay. Because in that case, stocks would be falling, and you would be buying assets that are falling. And so, in terms of buying the dip, so to speak, you would probably want to wait until there was some sort of catalyst to move higher. Whereas in the bond side of things, the catalyst to move higher is the peak of hawkishness of the Federal Reserve. When we know that we're going to see definitely the peak in rates, at that point you can start to dip a toe. I know that Jeffrey Gundlach of DoubleLine is already moving in that direction.
Well, what's interesting too, and I like this line in your analysis and reporting, about the long-standing premium for U.S. stocks staying in place because of maybe this expectations of people thinking the U.S. kind of the least hurt when it comes to the economic recession and leading the way out. Because this is something that we have day in and day out, Tim and I, with our TV colleagues, and we're talking about the markets in terms of trying to understand what the right valuation is with so much uncertainty looking forward. Final thoughts here. Just got about 30 seconds left here, Ed.
Yeah, I think that the final thoughts are that there's more risk outside of the United States, with in Europe in particular, with the war, inflation, and as a result, this long-standing premium that people are paying for U.S. stocks looks like it's going to stay in place, and that's partially because recession is going to be deeper in those countries as a result.
Yeah, they talk about the least dirty shirt, right?
Exactly. It kind of echoes what we heard from Brian Moynihan earlier with our own David Weston.
Yeah.
That the consumer here is looking good.
Right, and you start to look, right, exactly, right? Seems
so
to be holding
this
up.
recession with ammo.
And we'll watch for...
If there is a recession. Excuse me. I'll stop cutting you off, Carol.
Okay. Ed Harrison, thanks for finding time for us. Senior Markets Editor at Bloomberg News. Check out this story. It's on the Bloomberg and at Bloomberg.com. It is among our most read today.
Well, let's get a check on the latest world and national news. Ann Mostews in the Bloomberg Newsroom. Hey, Ann.
Hey, Tim. Hey, Carol. Ukraine's foreign minister calling for sanctions on Tehran after Iranian-made drones reportedly killed several people in the capital city of Kyiv. The minister says sanctions would send a strong message to any country thinking about helping Russia in its war against Ukraine. It's another setback for President Biden's economic message. With just over 3 weeks till the November midterms, the latest projections from Bloomberg Economics put the chance of a recession in the next 12 months at 100%. Wendy Schiller chairs the political science department at Brown University.
The Republicans are typically more unified, more coherent, and they on messaging, particularly for midterm elections. And in this case, the Democrats, because they had struggled so much to get their program enacted, I mean, it took a while, they succeeded, but all those struggles sort of just cloud messaging opportunity.
That's Brown University's Wendy Schiller speaking to Bloomberg. President Biden has repeatedly said the U.S. will avoid a recession and any downturn will be very slight. A Texas congressman wants fentanyl classified as a weapon of mass destruction. Republican Tony Gonzalez has filed a bill to make the changes as the deadly opioid continues to surge across the southern border. Gonzalez says the feds seized nearly 13,000 pounds of fentanyl this year alone. And it's the last day to file a federal tax return for those who requested a 6-month extension. That's about 19 million people. At this point, it's probably best to file electronically. Tonight at 7:07, Game 5, New York Yankees face the Cleveland Guardians at Yankee Stadium. The winner heads to Houston for Game 1 of the best-of-7 AL Championship Series Wednesday night against the Astros. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ann Mostu. This is Bloomberg.
And Mostu, thank you so much. You are listening and watching Bloomberg Business Week. Carol Master along with Tim Stanovic. And this just crossing the Bloomberg terminal. U.S. regulators are prying deep into the remnants of failed hedge fund Three Arrows Capital as they try to untangle the fallout of this year's crypto crash.
Yeah, Three Arrows Capital is a hedge fund that pretty much went belly up, Carol, as a result of a decline in prices of crypto. And the big question,
pretty prominent, though, right?
It was, I mean,
Until
at one point they had $10
wasn't.
billion in assets under management.
Yeah. So until it went. And
Yeah,
then
until, exactly.
filing for bankruptcy in July after the broad sell-off in digital assets. It's something we talk about a lot. Tim talks about it on his crypto show, and that was spurred in part by the collapse of the Terra blockchain.
Yeah, scrutiny from the agencies who are talking about the Commodity Futures Trading Commission and the Securities and Exchange Commission, both of which declined to comment, can lead to monetary fines and other penalties for firms and individuals. A lawyer listed in bankruptcy court filings as a representative for Three Arrows founders, Sue Zhu and Kyle Davies, did not immediately respond to email and phone calls seeking comment. The inquiries were made outside local business hours in Singapore.
All right, so here's what the regulators are looking at, too. And when we say regulators, we're talking about the Commodity Futures Trading Commission and also the SEC. They are now looking into whether the money manager violated rules by misleading investors about the strength of its balance sheet and not registering with the agencies. This is according to two people familiar with the matter.
The founders' whereabouts remain unknown. Zhu didn't respond to a request for comment. Davies didn't immediately respond to a message sent to him via Twitter. An advisory firm appointed by a British Virgin Islands court, Teneo, to liquidate Three Arrows, which is also known as 3AC, also declined to comment.
I mean, this is the wild run that has been anything related with crypto.
I mean, this is like a big piece
on steroids,
of,
it feels like.
when you think about the narrative of what happened over the last year, this is a major player, and this is not the last we're going to be hearing about the company.
No, exactly, right, as regulators continue to look into it. And I guess, I don't know, does some of it have to do with oversight and regulators not keeping up with these changing trends, or is it just poor management at firms and not kind of abiding by rules?
Who's that? You know, who ends up making that determination, right?
I don't know.
The
Anyway,
SEC, the CFTC.
there's a great write-through at Bloomberg.com.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell with the Dow, the S&P, and NASDAQ all advancing right now, holding close to session highs with the S&P up 100 points. That is a gain now of 2.8%. Dow Industrials up 606, up by 2%. We have got NASDAQ up 363 points, up 3.5%. The NASDAQ 100 index slightly better, up by 3.6%. A broad-based rally. Russell 2000 up 3.1%. The breadth of the rally is so strong that at one point, over 99% of companies in the equity benchmark were rising. 10-year yield 4.02%. The 2-year yield 4.45%. Spot gold up $2 the ounce to $16.47, up by about 0.2%. West Texas Intermediate crude oil is retreating, down 0.3%, 85.39 a barrel. So stocks begin the new trading week with gains, solid gains for the Dow, the S&P, and NASDAQ. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. If the Federal Reserve was hoping for some sign that inflation is subsiding, it was cruelly disabused by the latest figures for consumer prices. The headline rate fell slightly in September from 8.3% to 8.2%, but the more telling measure of core inflation reached the highest rate in 40 years. The message was clear. Far from relaxing its recent pace of monetary tightening, the Fed might have to raise interest rates faster than expected. It's tempting to think that, having fallen behind the curve at the outset, the Fed should now surprise investors in the other direction by announcing an unexpectedly aggressive tightening. But this approach would all but guarantee a recession, and one that could quickly turn nasty. That makes the Fed's preference for gradualism understandable and, for the moment, wise. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, just under 10 minutes left in today's trading session, getting ready to wrap up that Monday trade. And what a trade it is. While we have seen some movement, mostly it's game on and it's one for the bulls because we've got a broad-based rally underway.
Yeah, I've just heard the numbers from Charlie, but worth repeating. The NASDAQ higher by 3.6, the S&P higher by 2.9, and the Dow higher by 2% right now. Let's get into it with David at
Game
Dietz.
on. Isn't that Wayne's World, too?
Party on.
Party on?
Yeah.
Excellent. Sorry.
I love it, Carol. Blast from the
digress.
past. David Dietz is managing principal and senior investment strategist at PPAC Private Wealth Management, about $9.5 billion in assets under management. David joins us once again on the phone from Summit, New Jersey. So, David, is the worst behind us? Are we turning over a new leaf this week and for the remainder of the year?
Well, we don't know whether we've seen the bottom in this cyclical downturn, but we do know that the conditions are primed for better returns going forward. I mean, we start with the fact that we're down 25% year to date on the broad market, 35% on the NASDAQ. That alone should whet the appetite of all bargain hunters. On top of that, some of the macro factors that have really beaten down stocks, like a surging U.S. dollar and surging interest rates, reversed course today. Now, the bond market has seen yields go higher for 11 weeks in a row. Well, we know that yields don't grow to the sky. And so certainly the reversal today, I think, really helped people take more confidence that there was some limit to how high yields would be. And we know that bonds compete mightily for investors' attention with stocks.
Right. So it's always a comparison, right, in terms of fixed income bonds versus what we're seeing in terms of valuations and yield on the equity side of things. Having said that, at this point, you've got, David, some specific names on the equity side of things that you like, and among them is Tyson. Tell us about the story and the thinking behind that.
Well, in this part of the economic cycle, we're looking for market leaders. And when you look at the food category, we're talking chicken, we're talking beef, we're talking pork. Tyson is the absolute leader. They have a real lock on the domestic market, outpacing their competitors like Pilgrim's Pride. And increasingly, they're exporting to places like China, which has been battling swine flu and so forth. But this is a stock that, was over about $90 earlier in the year, and has come back mightily. Now it's got a 6 handle. And so, you got a market leader that now is trading at less than 10 times earnings, a company that has a history of buying back stocks, buying back their stock and increasing their dividend. And this is the type of thing we think where investors have gone too sour on the name, and it's going to come back.
Okay, what about Berkshire Hathaway? That's one of the companies on your list as well. Why are you bullish on Berkshire?
Well, you can't look at Berkshire without thinking about Warren Buffett. Of course, you've got the most successful investor, arguably, in the world, still on top of the helm there. This is a treasure trove, Tim, of blue chip publicly traded stocks. We're talking Coca-Cola, we're talking Apple, we're talking American Express, and of course, great privately traded companies, not small ones. We're talking Burlington Northern Railroad, Geico Insurance, some utilities in the Midwest, and they're trading just a little bit above book value. A couple things I think are the catalysts. One is, of course, interest rates have moved up. Now, they're famous for having all this insurance money float. Some of it they put to work. Others have been having challenges putting to work. And, of course, now they're getting a much better yield. And on the 3-month Treasury, you can get 3.8% versus nil about a year ago. On top of that, I like the fact that the heir apparent, Greg Abel, most likely to take over when Warren Buffett passes the baton, just bought $80 million worth of stock. Well, he's operating in a microscope. Everyone in the world is looking at the timing of this pick. He doesn't take throwing $80 million into his stock where he's going to be moving up, hopefully, lightly. So I think that is a great buy signal. And, of course, if Berkshire Hathaway continues to struggle, they have a great record of buying back shares. So that gives you a bit of a floor if you're worried about further volatility ahead.
What do you make of, it's funny, we don't talk about the Dow a lot because I think of its, limited names in the index. But having said that, the Dow is just down about 16% this year. That compares with about 22% downside on the S&P 500 and more than 30%, as you mentioned earlier, on the NASDAQ 100. For the Dow to see some outperformance, albeit not that much, but nonetheless outperformance, what does that say about you, kind of the Dow Industrials doing better than what we're seeing in the broader market and certainly a lot better than what we're seeing on the tech side of things?
Well, so
because you just talked about blue chips, right, liking Berkshire. So I'm just wondering what the bigger theme here is.
Yeah, it's a great question. I mean, frankly, the Dow has lagged over the last decade because so much attention has been focused and money chasing those tech stocks. And, of course, those have been hit really hard. The valuations got to nosebleed levels, fears of recession. On top of that, of course, with the higher interest rates, investors are discarding those stocks which have so-called long-dated earnings because they're marked down much lower to present value when interest rates go up. The Dow is much less focused on those high valuation growth names, and so I think it's been their turn in the sun. You've got more companies, your banks, like for example J.P. Morgan and American Express, your chemical companies like Dow, which are not only making good money now relative to stock prices, but also are paying a good dividend. And I think as interest rates move up, people have gravitated towards those lower duration equity names.
Hey, David, before we let you go, talk a little bit about inflation and what you're seeing, because we got some concerning comments from Mark Mobius a little earlier today. What do you think is happening with inflation?
So the latest numbers are terrible. So there's two things I would say. One is I think inflation is starting to roll over, quite frankly. Why do I think that? One is commodities tend to be a leading indicator inflation-wise. You look at the price of oil, it's got an 80 handle versus, close to 130 late spring. Ditto with all your other commodities as well. We also are seeing distinct signs that the economy is starting to slow. And when people have less money to spend, companies are pulling in their belts. They're not going to pay those high prices, and so we're going to see prices come back. So I think that inflation is going to tend to roll over. Finally, stock investors are still worried about inflation. I think your risk and the downside if inflation takes longer to purge from the system is smaller than your upside if, in fact, we get some good news here on inflation.
All right. Well, certainly one take on inflation and where it goes. David Dietz, thank you so much. Managing Principal and Senior Investment Strategist at PPAC Private Wealth Management, roughly $9.5 billion in assets under management, joining us once again on the phone from Summit, New Jersey. Just a few minutes left in today's trading session. We're just off our highs of the session. A little bit of selling I'm seeing as we get into the close, but just still holding on to some big gains. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We are counting you down to the close on this Monday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast with Carol Massar and Tim Stenovic. We welcome our Bloomberg audiences across television, radio, as well as on YouTube. And Carol, another wild day here. I mean, you have the S&P up 2.5%, the NASDAQ indices up over 3% here on the day. But we've been here before. We were here on Thursday, and then, of course, on Friday, we had the exact opposite. Does this have legs?
Yeah, this is a big question at this point. I've seen this movie before as well. What's interesting, we're seeing a little bit of rollover in these last few minutes of trading. So we're coming off our best levels of the session, so a little bit of selling here into the close. But I've been kind of blown away by some of the names like Meta, up 5.6%. Amazon's been up more than 6% today. Same story for Netflix. So really some of those big FANG stocks really pushing the charge ahead today, Tim.
All right, we'll see what happens when it comes to some of those earnings that we get a little later this week. We did hear from David Dietz, Managing Principal and Senior Investment Strategist at PPAC Private Wealth Management just a few minutes ago. He did say that valuations are favoring stocks right now. And he also mentioned that inflation is starting to roll over, pointing to commodity prices coming down, seeing distinct signs that the economy is starting to slow, which could lead to inflation coming down a bit. But, have we heard this before?
No, I mean, HSBC had a similar note this morning, looking at least 7% inflation through January. And then, of course, that tricky spot is, Tim, to your point, commodities and the lack of demand for commodities if you start to see some of those roll over, and how then quickly does that come off 7%?
And you've seen that to a certain extent in the metal space. I remember most of those metals were up 20-30% on a year-to-date basis earlier this year. Now they're all down about 15-20% here. Of course, energy hasn't quite rolled over just yet. So we'll keep an eye on that space right now. Keep an eye on the closing bells here in New York. People clapping, people cheering, and they have reason to. The Dow Jones Industrial Average higher by more than 500 points, or about 1.9%. The S&P 500 higher by about 2.7%, and the NASDAQ on a close higher by about 3.4%. Meanwhile, you have the Russell 2000, something that Taylor's been talking about, some of these small cap names. The Russell closing higher by about 3.2%, and we should just point out that the mid-caps, the S&P mid-caps higher by 2.8.
All right, we're going to get into the groups, and I know Taylor's going to go through them, but I've got to say I've been really watching some of those big banks, which were up another, overall, the group overall, because of earnings, up another 3%. In the last 3 trading days, we've seen, Taylor, almost a 7% bump to the upside.
Yeah, I mean, take a look at where we are on some of these sector levels, Carol. It is wild when you think about every sector is in the green. And what is wilder is that I think we've done this a few days last week alone, and here we are again doing this again. Auto components, retailers up as much as 4.25% to 6%. Media's in there as well. Banks have had a huge day, of course, given the better than expected, I would argue, maybe decent, of course, quarterly results from the banks. And real estate's up almost 4%. They catch a bit from yields that finally take a little bit of a leg lower and a little bit of a reprieve. Otherwise, it's actually those inflationary sectors, Carol, that are the underperformers. You're only up 1%. It's household products. It's food and staples and food and beverage. 1% or so on the day.
Yeah, looking at all that green makes me wonder, bear market rally, or are we finding a bottom? Hard to say. All right. As for some of the gainers, the individual gainers, there was so much for me to choose from today. I did hone in on Tesla in particular because it was top in the S&P 500 and the NASDAQ 100, up about 7%, so just off its highs of the days. And despite a story in Barron's citing a long-term Tesla pessimist saying the shares could be a zombie stock as interest rates rise, and despite Mercedes coming out with a new electric SUV that's aimed at the Tesla Model Y. Keep in mind, Tesla, of course, reports on Wednesday after the market close, so that's definitely on our radar. Roblox also on our radar today. This stock up as much as 22% at its highs today, finishing with about a 20% gain. Gaming platform reported a surge in September bookings and daily active users.
And
what?
Can I do interrupt you and do a trick question for Romaine? How did they change their revenue recognition, Romaine?
I don't know, Taylor. Is it first in, first out? I mean, Roblox doesn't have is it LIFO, IFO?
It doesn't involve
What is it?
NFTs. It doesn't involve NFTs.
Carol, I don't mean to
How
interrupt.
how
they
did they?
expanded the lifeline of user engagement, which lowers revenue, but otherwise it's a positive sign.
You sound like a CFA charter
I
holder.
love when you
Taylor.
talk accounting. It makes me so happy. Well, and anyway, investors bought into it. The stock, though, 11% of the float is short. So I just want to put that out as well. And News Corp, remember we got the news late Friday. News Corp continuing to trend higher, did in the after hours on Friday, up another 3.5% today. Rupert Murdoch talking about recombining News Corp and Fox, bringing together a business that was split apart about 9 days ago. So anyway,
Years.
his name, years ago. Yeah. Sorry, 9 years. Sorry, did I say 9 days?
Yeah.
Yeah, that would be really a turnaround.
That would be quite a. We use the pivots, but that would be quite the pivot.
Yeah,
That'd be
only
quite
in
the
the
bit.
UK.
9 years. All right, Tim, all yours.
Okay, well, Fox shares may have been higher today, or excuse me, I should know. News
It's a
Corp shares
Monday.
may have been higher today. Fox shares certainly weren't, finishing down by 8% today. This is analysts and investors digest that news that we got Friday about a potential reunification of News Corp and Fox. Cano Health falling 42.5% today after Deal Reporter reported that CVS will not pursue a deal with the company at this time. And Kroger saw a few downgrades today. It fell 2.43%. We saw price target cuts at MKM, Guggenheim, and then North Coast cut it to neutral. Shares falling 2.4%.
Meanwhile, if you go cross-asset, very little was in the red today. I'm going across to commodities first and foremost. Natural gas off by another 7%. We're getting some really big moves in natural gas prices here in the US, pulling lower as we see perhaps demand ebbing somewhat in terms of, and actually some pretty strong production. So we're seeing natural gas on the downside. Oil was pretty unvolatile amid a very volatile day in the likes of FX and in the likes of other key areas like stocks and bonds. We're seeing some metals roll over, iron ore in particular under pressure as that key speech coming from Xi Jinping in China didn't hinder any changes in TAC when it comes to COVID policies. I'm looking at what happened in the Forex, in the foreign exchange area, because really it is strength against everything versus the dollar today. British pound up, strengthening 1.6%. Why? Well, that U-turn that finally has happened. Now the tax cuts that were likely to be given away are now being retracted by the new Chancellor of the Exchequer, Jeremy Hunt. Canadian dollar was also seeing some strength. The euro seeing some strength ahead of comments coming from the ECB at the moment. But really, this is a story of US dollar lower as we do see maybe a little bit more risk on tone to the day, which could have been kickstarted in large part by the United Kingdom, that also saw gilts come screaming down in terms of yields. We're up by 35 basis points on the 10-year as people start to buy a little bit more of the fiscal stability being talked about in the UK thus far and really buying across the bond market in Europe, Taylor.
Well, you got a little bit of a reprieve, at least on the front end. Yields are falling about 4 basis points or so on the 2-year yield, which certainly has been bucking the trend of the last few months and certainly the year. But we hold on to about a level of 4.45. And as we've been mentioning, a 10-year yield that rounds out unch on the day, but holding above 4%, a 4.02. So you can now firmly go out all the way to the yield curve, even out 30 years, and you're still getting over 4%.
All right, I'm not quite sure where to go here because we've got a bunch of earnings. We're hearing from the big banks. I love this story that came out on the Bloomberg about all the banks are basically saying no recession, consumers doing well. So how do we kind of play that out? And I guess I'm going to wait for some of the economic news. We're going to get a lot on the housing market this week, see how bad it is. And as companies, certainly in the consumer space, start to report what those CEOs
Well,
have
we
to
got,
say.
it's interesting because we did get that Empire Manufacturing
That was
data
weak.
this morning, and we're going to get the U.S. industrial production numbers, I think, tomorrow, if I remember correctly.
Yep.
So I'm actually kind of interested in that, more as a read on what's going on in the goods producing sector. And remember last time we got those U.S. production numbers, there was sort sort of an imbalance, if you will, between sort of what was coming out of factories and whether that was going to be enough to offset maybe a potential slowdown in the services side.
I'm, of course, also interested in the companies that are reporting earnings. We got Johnson & Johnson, we got Hasbro, we got Lockheed Martin, Netflix, we got United Airlines, we got Tesla, the list goes on. Not as many as we have next week, though. But commentary from these companies will be very important. How many consumers are quitting Netflix?
Have you switched to the new ad tier, Tim?
I have not switched to it. What about you?
He's not saving his pennies quite yet. But
you know, I don't know if it's people. I don't know. That's a good question, though. I don't think it's necessarily people downgrading versus getting those people back who might have quit because they didn't want to pay that full price, right?
But at the moment, as you say, what is the commentary going to sound like? Is it going to be as lackluster, as concerning as many of the structures have been downgrading their outlooks, 19 straight weeks of downgrades rather than upgrades, but also the fact that, Bloomberg Economics sees a 100% chance of a recession now if you go out to next year, a 100% chance, yet that doesn't seem to be being echoed by the bank CEOs.
Certainly not, and certainly from some of these even CEOs that we're going to be hearing from the calls. We're talking to people today and they say, yeah, things are, slower than maybe they were last year, but nowhere near sort of the dire forecast and nowhere near what it would look like back in 2000.
And for investors, it's really, okay, so what's going on in the U.S. market? What's going on in UK? Like, does the U.S., by comparison, look better than what's going on in Europe? Yes. And so as a result, attract a lot of investor assets.
I don't know if the ad tier is out yet, by the way.
No,
we have to wait. I think we have to wait a few weeks for that.
It's coming.
Yeah, November, and they're just testing it out at this point. But
he's testing you.
Well,
okay.
It's coming.
All right.
It's coming, Tim. Don't worry.
I just want to clarify there.
All right.
Okay.
I mean, what do you're probably like a Peacock guy or something ridiculous. Right?
I'm afraid to say we got all of them.
He's a Hulu kind of guy.
We got all of them. We really do.
Where'd you get the time?
That's good.
We don't watch them. We just
pay
for
them.
Pay for them. Exactly.
Yeah,
You're exactly the customer.
Reminded every month when I look at the credit card bill that we subscribe to all of them.
Yeah, it's like gyms, you know.
It's the new bundle.
We do subscribe to like a gym thing too. It's $24 a month.
Yeah, you go subscribe to the gym and don't show up. You're the perfect customer.
It's a streaming gym.
Yeah.
All right.
Wonderful.
I think we're done.
He's so millennial.
I got nothing for you. I got nothing. I'm going to try and live
bikes
life.
in the work. You bike across the river? How do you get across the river?
He's on a Peloton.
Backstroke. All right, we got to run. We will be back again, same time, same place tomorrow. We'll count you down to the closing bell on Tuesday. We call it Beyond the Bell.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
That is so true about the cable, not the cable, but the streaming bundle. It's ridiculous.
Every month I'm like, I got to quit some of these.
I know. And the thing is, every time my husband's like, well, I think I'm going to get rid of it. I'm like, no, you can't. And then every time we go to look for something, I'm like, there's nothing out there.
Everything is on.
It's really sad. All right, folks, listening and watching Bloomberg Business Week on this Monday. Right now, World and National News with Ann Mostu. Hey, Ann.
Hey, Carol. Hey, Tim. The formal launch of President Biden's student loan forgiveness program kicked off today. Biden pledging his team will keep an eye on glitches and process the debt relief for those who qualify, urging them to go to studentaid.gov and apply.
My commitment was, if elected president, I was going to make government work to deliver for the people. This rollout keeps that commitment.
The deadline for submission is December of next year. The White House says Russia's missile strikes on Ukrainian civilians shows Putin's brutality. Press Secretary Karine Jean-Pierre says President Biden is in contact with Ukrainian President Zelensky regarding the latest attacks, and the U.S. will support Ukraine for as long as it takes. Early voting began in the state of Georgia today, including votes for one of the nation's most watched Senate races between current Democratic Senator Raphael Warnock and Republican hopeful Herschel Walker. Walker, backed by former President Trump, did not appear at a scheduled debate last night after Friday's intense showing. Saw Walker rebuked by the debate moderators after flashing a reportedly fake police badge during questions about his supposed previous service as a law enforcement officer. After casting his ballot at an early voting site today, Senator Warnock urged voters to consider who they want to represent them for the next 2 years.
The issues are too urgent, the stakes are too high, and quite frankly, the differences between me and my opponent are too wide for us to wait until Election Day. The people of Georgia deserve a serious person to represent them at serious times.
Democratic Senator Raphael Warnock. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ann Mostu. This is Bloomberg.
Thank you so much, Anne. So we've talked about earnings. We've talked about the new streaming bundle. We've talked about all the economic news to come. Recession, no recession. What's the Fed going to do? If you're in New York, you're a New Yorker, you got to talk about rats.
Yeah, New York City is, by the way.
Or something completely different. What?
Are they this bad in New Jersey? Do they swim across the Hudson, Carol?
They do.
They do backstroke.
They do the backstroke, too.
It's bad in New York City.
One of my not favorite things is sitting on a subway platform and just watching the rats on the track. Once they've actually come up on the platform, and I started to move away because they're pretty aggressive.
Okay, well, what's worse is living in the East Village 12 years ago and walking somewhere and a rat just scurries across your foot, because that's happened to me. So it's been an issue for years here, and New York City is now limiting the window for residents to take out their trash to the nighttime. This in an attempt to cut back on the piles of garbage bags flooding its sidewalks and attracting rodents. A big reason why we see these rats. But by the way, Carol, have you ever walked by a trash can? Not even a trash can, a trash bag, and it starts moving?
It's not funny.
That's when there's a rat inside that trash bag. It's funny when people come to visit you in New York who haven't spent a lot of time in the city, and they're like, why is there trash everywhere? And you say, oh, because that's how we've done things in New York for a century. We just put the trash on the sidewalk. Not in bins.
No.
Not in big, dumpsters, like if you travel to Europe and, you see big dumpsters in cities.
Do you guys not put them in garbage bags? No, you just put them in bags?
Yeah.
What do you do in New York? Because I live just outside New York. I have garbage cans, and I'm in an urban environment, too.
You just put them in bags, and they collect on the sidewalk. It's pretty bad.
All right, so now the city's going to change the time households and businesses are allowed to take out the trash to the street for collection to 8 p.m. from 4 p.m.
4 hours fewer for the buffet, as we heard from Sanitation Commissioner Tisch.
Sorry, rats.
She called it a buffet.
Did she really?
Yeah. Maybe it was the mayor. It just sticks with me.
But it's got, and during the pandemic, people had horror stories about the rats everywhere because the normal food collection or the normal trash and stuff, I guess, wasn't out there. And so they were scrambling big time and getting pretty brave and just out there on the streets.
It's a great city, though.
Welcome to
It is a great city, okay?
Welcome to
Rats
the Big
and all.
Apple. Yes, it is. All right, this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stock surged. The Dow, the S&P, and NASDAQ all advancing today, ending close to session highs. S&P up today by 94 points, a gain of 2.6%. The Dow rallied 550 points, up 1.9%. NASDAQ was up 354. For the NASDAQ Composite Index, that was a gain of 3.4%. 10-year up 1/32, 10-year yield 4.01%. The 2-year 4.44%. Spot gold up 0.3%, $16.49 the ounce, and a retreat for crude. West Texas Intermediate crude down 0.1%, $85.52 a barrel. So big gains for U.S. stocks today. S&P found support at a key technical level, and another giant bank, Bank of America, came out with solid results. Bank of America today up by 6.1%. Tomorrow, Goldman Sachs reports. Goldman today up by 2.2%. Again, recapping a rally on Wall Street to kick off the trading week. S&P 500 index higher today by 2.65%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So a lot going on when it comes to ESG, and we talk about, obviously, climate nonstop. And there's about 3 weeks to go until the start of COP27. That's going to happen in Egypt. And the need to urgently address the climate crisis has never been clearer. Pakistan and Nigeria have experienced devastating flooding this year. Europe, as you know, sweltering in a record heat wave over the summer. And Kenya and Somalia have been ravaged by a catastrophic drought, which makes you think about the big macro climate issues that are going on, and then how it impacts the investment climate.
And how do we measure climate impact? That's a big question I think that a lot of people have when it comes to not just their own companies, but also investments that they make. We've got Laura Zizzo with us. She's co-founder and CEO of Manifest Climate. It's a SaaS climate risk planning solution. She joins us on the phone from Atlanta this afternoon. Laura, how are you?
I'm well, thanks. How are you?
Yeah, we're doing well, thanks. Thanks for joining us on this. Can you explain what exactly Manifest Climate measures? What tools do you have, and what data points do you use to measure climate impact?
Right. So we know that we're going through a climate transformation, just like we went through a digital transformation. But I say we're in this pre-HTML era of climate change. So we need a common language so we know how to navigate this climate transformation. And we think by pulling information from public disclosure of publicly traded companies, how they're talking about climate change, we can help understand how they're moving through that transformation. It's much more complex than just understanding their greenhouse gas emissions. It's about their processes and their policies of integrating these climate-related risks and opportunities into core business.
So can you be more specific? Like, give us a, for example, when this company talks about this, how that translates into data or, useful information on your platform.
Right, absolutely. So we know that some of our asset manager clients, for instance, are looking for proxies for good governance related to climate. So we'll look for things like how they're talking about what committees of the board are thinking about climate change, who's in charge from a C-suite or management level, and we can categorize all of this into action items and help organizations understand where they sit in their climate competency. So we're looking for specific language around what governance is the company have, how they're integrating risk management into core business strategy. So if you have an enterprise risk management strategy, how exactly are climate risks and opportunities identified and integrated into that?
So what do you mean?
For instance,
yeah, go ahead. I was going to say, what do you mean by that?
Yeah, so if you're a real estate investment trust, for instance, like we've known for a long time that there's operational issues related to energy use. But we also need to think about how are you thinking about where these assets are located and what risks related to the climate impacts can be integrated. So are you thinking about future storm surge and how you're thinking about infrastructure improvements related to that? And are you talking about that with clarity so investors can feel like you've got your eye on this problem and you can think about how you're going to shore up resiliency into the future?
But do you think the market prices those things in from a real estate perspective? I think about that a lot because we hear about just, for the last year, so many people moving to Florida, for example, sky-high prices in California as well, a place that's really affected by a drought and a lack of water. And it doesn't seem like we know these things, but it doesn't seem like the market is pricing these things in.
Exactly. I think that's what organizations like Manifest Climate are trying to, the problem we're trying to solve. How do we actually connect the dots so that market can actually price this in and make better decisions? And investors are increasingly asking these kinds of questions. They need to understand how you're preparing for this long-term value creation. But I think that the answer is no right now. We're not adequately pricing this in. So we're seeing more and more tools out there to give that proxy for the price signals that we're looking for in the market.
Hey, Laura, so what do the companies that you work with or asset managers that you're working with do with this information? Is it how they base their investment decisions, or more broadly, how are they using the information ultimately?
Yeah, it's becoming a competitive advantage to understand this. So one of our asset manager clients says they're actually seeing alpha related to good governance disclosure. So it's not as simple as saying, you know, these companies are the ones we're going to focus on, but they're looking for these sort of proxies for good governance. And they're also looking for clarity in the transition plans. We talked a lot about, are you thinking about how you're going to transition to net zero? We've seen a lot of ambition, right? We've seen people say, totally. Net zero by 2050. But they're looking for specifics like, what are you doing now? Is this more than lip service? And if there's a clear understanding of, we're doing something right now, it's not good enough, no one's doing good enough on this, but we have something to say that's more than just ambition, that's what investors are looking for. And they're going to start holding these companies to some of their plans.
Can you give us a few companies that are doing this really well?
You know, more and more, I would say Microsoft is a really great example. When they came out with their carbon pledge, you know, they said, we really want to think about how our business will help transition. And I always say, this is not philanthropic on their part, right? Like, they see this as a business opportunity. The Bank of America just said, and I heard right before the segment, you're talking about the Bank of America, they're saying there's $130 trillion that needs to move as we get to net zero. So companies like Microsoft say, we need to be part of that transition. How can we help move to that net zero future? And they actually have a business strategy aligned with that. So that's the type of things that investors are looking for.
No, it's definitely a part of, you feel like increasingly so because of the impact climate change is having on our world, the costs, that it definitely is having a bigger say, if you will, and having some kind of platform that can identify it really makes a lot of sense. Hey, Laura, thank you so much. Laura Zizzo, co-founder, chief executive officer of Manifest Climate. They work with companies to track and report on climate change. Laura, by the way, a former delegate to the United Nations Framework Convention on Climate Change. She's also a lawyer, so good to catch up with her. But this is, you know, I can just see more momentum around what she was talking about.
Once again, though, I go back to the example that you and I talk about, that when we're in earnings season right now, investors don't punish companies necessarily for their environmental impact right now. No. We talk about bottom line, we talk about top line, and we see shares of a company move as a result of those reports, but we don't hear about carbon output, for example.
No, exactly, right? And unless you're penalized, like, you do wonder, I don't know, how it really plays out in the public markets. All right, folks, we're going to continue right here on Bloomberg Business Week. Carol Master, Tim Stanovic, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So if you're a loyal listener and watcher, which we certainly hope you are, of Bloomberg Business Week, you know one of the things Tim and I like doing is getting down to the local level, and that means talking with mayors around the country.
Yeah, we're going to be joined in just a few minutes by Maddie Parker, the mayor of Fort Worth, Texas. Got a lot of questions about why everybody's moving to Texas and what she's seeing there.
Including crypto, which you brought to our attention.
Yeah.
Right?
They're doing some crypto stuff.
All right, we'll get to that in just a moment. First up, though, back to your top business stories and look at that rally on Wall Street on this Monday. Here's Charlie.
Indeed, what a day on Wall Street here. Start of the new trading week with the Dow, the S&P, NASDAQ all surging big time today with the S&P up 94, gain there of 2.65%. The Dow up today by 551 points. That was a gain of 1.9%. The NASDAQ Composite Index up 354, up 3.43%. The NASDAQ 100 Index up 3.5%. Broad-based rally. How strong was it, you ask? It was so strong that at one point over 99% of companies in the U.S. equity benchmark were moving higher. So raises the question, have we seen the bottom for stocks this year? David Dietz is Senior Investment Strategist at PPAC Private Wealth Management. He was our guest right here on Bloomberg Business Week.
We don't know whether we've seen the bottom in this cyclical downturn, but we do know that the conditions are primed for better returns going forward. I mean, we start with the fact that we're down 25% year to date on the broad market, 35% on the NASDAQ. That alone should whet the appetite of all bargain hunters.
And today, the 10-year yielding 4.01%, the 2-year yielding 4.44%. Spot gold up $5 the ounce to $16.50, a gain there of 0.4%. Down day for West Texas. Intermediate crude down another 0.1%, 85.56 a barrel. American Airlines passengers have urged a federal court to preliminarily approve a deal that would pay at least $7.5 million to fully refund baggage fees to customers who've been promised they could check their bags at no cost. Today, we had airlines flying higher for the most part. American up by 0.7%. Of course, big operations at Dallas, Fort Worth. UAL up 1.9%. Delta up 0.2%. Southwest down 0.1%. JetBlue rallied 2.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you. Well, earlier this year, Bloomberg News reported on how Fort Worth, Texas, which is the 5th largest Texas municipality, was jumping on the crypto bandwagon, approving a plan to mine Bitcoin with computers located in City Hall. The move, according to Fort Worth, would make it the first city government in the U.S. to mine Bitcoin.
We got the mayor of Fort Worth, Texas, with us right now, Maddie Parker. She joins us via Zoom from Fort Worth, Texas. Mayor Maddie, good to have you with us. How are you?
Thanks, Carol. Thanks, Tim. Good to be with you.
Well, let's start with Bitcoin, because Carol so elegantly told us at the top there that you guys became the first city to mine your own Bitcoin from City Hall. Give us an update there. How's it going?
It's actually been a really interesting pilot program for the city of Fort Worth. We'll get an update from city staff in the next few weeks. But really, the thanks goes to Texas Blockchain Council for helping make it possible. We had those machines donated to help it be at no cost to taxpayers, able to plug them into City Hall and just really try to be on the forefront of the learning curve of what cryptocurrency really means in this country right now, and also blockchain technology, and be a city that's welcome to innovation.
We do know that crypto mining, specifically Bitcoin mining, uses a ton of energy. It's not a technical term, but it uses a lot of energy. We did see some miners taken off the grid during recent power crises in Texas. Did you guys have to disconnect the computers at all at times over the summer when you had to turn the air conditioning up really high?
Really, the lucky thing for us, where they're part of our IT departments, they make those decisions based on what they would do with the rest of our IT equipment in any kind of surge scenario. So in our situation, they just followed along the same lines as what city staff recommended. So we didn't really have it. We have only 3 machines. So we're a pretty small dent in what you probably have seen across major mining operations and across the country.
All right, so wait. So I know when we reported on it, the computers are located in City Hall. And so it's 3 mining rigs, as you said, donated by the Texas Blockchain Council. Why are you guys doing this?
Well, you know, honestly, Fort Worth wants to be known and synonymous with innovation and technology, and this is an opportunity for us to get noticed in the right ways. And truthfully, it worked. I mean, we had over 780 million impressions across the globe about what Fort Worth was doing, and got new inquiries from other technology companies, even if they really weren't involved in cryptocurrency, to ask the question, hey, if you're willing to do this and take a risk, so to speak, and work alongside other technology companies, what would you be willing to do in the future as well? So that's the real why behind the city of Fort Worth. And again, cryptocurrency is one piece of this. The future of blockchain technology in a multitude of different industries is something I'm personally very interested in, and want to make sure Fort Worth's at part of the conversation.
Okay, so we know that the city is planning to reevaluate the program after 6 months. It's been about 6 months. What does that reevaluation look like, and is there a chance that the city would abandon this?
Absolutely, and anything could be abandoned at any point. It's a pilot program for a reason. That's what we promised to city officials, to kind of understand what the advantages were, and what the program should evolve into. Importantly, is it just mining Bitcoin, or do we need a more robust program in the future to really be meaningful? And I think that's the point we're at right now, to kind of determine what next steps are. The Texas Blockchain Council has been immensely helpful in the expertise that they offer.
So it's interesting. So talk to us about, it sounds like you and so many other cities are thinking about things to attract people coming in. Tell us about the folks that have been coming into your city specifically. What kind of, where are they coming from, and how many?
Yeah, well, good question. I mean, right now, Fort Worth experiences 328 people moving here every single day, which is hard for people to believe. We don't have a problem attracting folks to Fort Worth. So it's important we really understand what it looks like as you're attracting new talent to our cities. How do you also attract the businesses and jobs to come along with those, and also be responsive to the amount of growth that we're seeing in the Fort Worth region? North Texas and Dallas-Fort Worth region will soon pass Chicago as the third largest metro in the entire country. So being in front of the infrastructure needs is incredibly important. But honestly, during COVID, you saw this across the entire country, people moving to where they wanted to experience quality of life. And fortunately for us in Fort Worth, we do have that, and it's a place where you do want to raise your family or build your business.
Mayor Parker, Mayor Maddie, where are they coming from? Is it the East Coast, or where are you finding that they're coming from? And
in Texas, good question. About Texas, about half the migration is domestic migration across the United States. A lot of them are coastal cities, places like Los Angeles, San Francisco, New York, Seattle. Those are some pretty predominant communities. But also about 50% of the growth is natural, new babies being born across Texas, and people having additional family members come join them. So I think it's a mixture of both the two. I think here in Fort Worth, you're seeing most people, they could work from anywhere, they could move their companies, and you're seeing more tax invasive states be a place they're fleeing from. And Texas is an incredibly welcoming, open for business type environment. So I think you're seeing a lot of success here in North Texas because of that.
Mayor Maddie, we only have 45 seconds left, but we're going to come back with you in just a few minutes. Carol, actually, let's chat about what we're going to talk about with the mayor in just a few minutes when we come back. Questions about who is coming, specifically when it comes to, are companies relocating, or are these people who are able to work remotely now? That's something I want to try to get to the bottom of.
Yeah, and I'm curious, too, about upcoming elections and, the political climate and how that shapes into strategy and her plans and strategy in terms of growth going forward. So a lot more to get to. As we said, we love catching up with mayors around the United States. As we said, we're talking with Fort Worth Mayor Maddie Parker. She is the 45th mayor of Fort Worth, and we're going to continue our conversation in just a moment.
In the meantime, let's get a check on the latest world and national news with Ann Mostu in our Bloomberg newsroom. Hey, Ann.
Hey, Tim. Hey, Carol. As we head into the final weeks before the midterm elections, Georgia's incumbent Democratic Senator Raphael Warnock is leading against challenger Herschel Walker. That's according to our forecasters at 538, who called Georgia the likeliest tipping point for control of the Senate. Here's 538's Galen Druk.
Right now, Democrats have a 2 in 3 chance of holding control of the Senate. Republicans have a 1 in 3 chance. If Warnock wins, Democrats' odds go up significantly. Of course, if Walker wins, Republicans' odds go up significantly.
Again, that's 538's Galen Druk. Ukraine's foreign minister is calling for sanctions on Tehran after Iranian-made drones reportedly killed several people in the capital city of Kyiv. The minister says sanctions would send a strong message to any country thinking about helping Russia in its war against Ukraine. Gas prices are holding steady to start off the week. AAA puts today's nationwide average for a cost of a gallon of regular unleaded at $3.88. That's unchanged from yesterday. And Halloween candy prices are getting a little scarier this year. According to the Bureau of Labor Statistics, you can expect to pay about $2 more for a typical large bag of candy this year, the biggest yearly jump in candy prices that the CPI has ever recorded. And tonight at 7:07, it's Game 5 of New York Yankees face the Cleveland Guardians at Yankee Stadium. The winner heads to Houston for Game 1 of the best-of-7 AL Championship Series on Wednesday night against the Astros. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ann Mostu. This is Bloomberg.
All right, Ann, thank you so much. Ann Mostu there with World and National News. We're going to get back to the mayor of Fort Worth, Maddie Parker. We'll get back to her in just a moment. In the meantime, there is a story we didn't get to so far we wanted to mention. It was actually, I think, trending pretty highly when it comes to social media, which kind of makes sense.
The rapper formerly known as Kanye West has agreed to buy Parler, a social media platform that has been embraced by conservatives who departed Twitter over allegations of political censorship. I didn't know it was called Parliament Technologies. Did you know that either?
No, and that's the parent company behind Parler, announcing today that it plans to sell the social media platform to the hip-hop icon for an undisclosed amount. The deal would include technical support from Parliament, such as cloud services.
Ye is buying, Kanye.
That's what he's known.
Yeah, what he's known as now. He's buying his own social media platform at a time when the biggest tech firms are struggling with how to control and manage some of their largest users. It marks the continuing development of alternative social media sites. Let's go through some of these sites, Carol. We got Twitter, which is right now in the process of being acquired by Elon Musk. Haven't talked about him today yet, have we?
That happened.
Yeah.
Oh my
all right.
gosh.
So we'll try to keep it that way, at
We
least
ain't done
until the show's not over yet. And then you have Parler, and then you have Truth Social, President Trump's social network. So if we think about what's happening with social networks, there's at least a desire by many wealthy individuals to create spaces for conservatives.
Well, and this is coming in the face of more and more restrictions by various social media platforms. Ye, we know, has recently faced restrictions from the major social media platforms for breaking content policies. Twitter removed an anti-Semitic tweet from him last week and locked his accounts just one day after he returned to the platform for the first time in nearly 2 years. Instagram has also deleted posts. So increasingly, folks where they are being blocked are looking for alternative spaces on social to put out their views.
There's another one, Rumble. It's a conservative video network backed by billionaire Peter Thiel and a VC and Republican Senate candidate J.D. Vance. He's running in Ohio. Became a publicly traded company through a deal with a blank check firm.
What's sad about this to me is then you create these vacuums of people with the same thought rather than a platform that has different points of view and everybody gets to kind of play around with it.
Oftentimes I just see reposts of President Trump's Truth Social posts on Twitter anyway.
Yeah, that's a good point. All right, we're going to get back to the mayor of Fort Worth in just a moment.
Council.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Big gains to start off the new trading week. A rally for the Dow, the S&P, NASDAQ, and NASDAQ 100 index. NASDAQ 100, the outperformer today, up by 3.5%. NASDAQ Composite Index up 3.4%, rallying 354 points. We'll give you the why in a moment here. S&P up 94, higher by 2.65%. The Dow today up 551 points, up 1.9%. The 10-year yield, 4.00%. The 2-year yield, 4.44%. Stocks are big gains. The S&P 500 closed above a key technical level, and another giant bank came out with solid results. That giant bank, Bank of America, shares surged today by 6.1%. Tomorrow morning, we'll be hearing from Goldman Sachs. Goldman today up by 1.8%. Spot gold up 0.4%, $16.50 the ounce. West Texas Intermediate crude down 0.1%, $85.58 a barrel. Bitcoin, a topic we were just talking about, up today by 1.1%, 19,541 on Bitcoin. Bottom line here, big rally to kick off the new trading week. S&P 500 index up 2.65%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get right back to our guest, and delighted to still have with us from Fort Worth, Texas, via Zoom, the 45th mayor of Fort Worth Mayor Maddie Parker. So, Mayor Maddie, you know, I am curious about the political climate, and you have taken positions that are against the kind of Republican thought, if you will, and been, it feels like, more open-minded, whether it's about transgender kids or other issues. So, does that make things difficult for you?
It honestly doesn't. I mean, I've always been known as someone that speaks my mind. I think I was pretty honest about that when I ran for mayor. I just want to be known as a mayor for all people that's really welcoming city, which I know that we are, and try to turn the political temperature down a bit. I think no matter if you're far left or far right, I just don't think that's how you govern, and it's certainly not my mentality as a mayor of a large growing city. And so truthfully, it's actually made my job easier. People are more approachable. We don't always agree on things. My role is to be, you know, a compromise agent, and that's absolutely how I operate here at City Hall and working alongside my city council members.
Is it frustrating to you to see some of the positions that prominent Republicans take nationally when you get concerned about being painted with that brush? I think about questions about the election of 2020, for example, or what happened on January 6th. Or even abortion, potentially.
So I think for me, you know, I actually decided to run for office here in mayor of Fort Worth in 2021, right after January 6th. So I was heartbroken, as were most Americans, at the situation and what happened at our nation's capital and what that means for our democracy. And I've been pretty open about that. But again, my role is really to try to be forward-looking on behalf of not just the residents of Fort Worth, but the residents of Texas. You know, I think of myself, obviously, there's been a lot of conversation about my age. I'm 38 years old, a mother to 3 children. My husband and I live here in Fort Worth. I feel like I have a really good pulse on what's happening in my community. And regardless on maybe the topic and how contentious it may or may not be, I try to have a listening ear and again, turn the temperature down. What you see on social media, or sometimes it's portrayed in the media, is oftentimes not how you actually have to interact with people and listen to their ideas and positions to really get things done.
Well, where, you know, in terms of, since we've got midterms just around the corner, and then, of course, we're going to have a presidential election, you guys have a gubernatorial race. Is, you know, a Governor Abbott versus a Governor O'Rourke, is one thing better for you in terms of your city, in terms of strategy going forward?
It's really not. I mean, I think both governor candidates, obviously Governor Abbott, and I don't have a relationship with Mr. O'Rourke, but to understand what they were going to really do on behalf of Texas cities. We're a fast-growing infrastructure, mobility needs are significant. Investments in education, understanding all of those things are really important to me as mayor and also as a mom here in Texas. So I'm just like every other Texan, watching that race really closely and looking forward to the election being over in November.
I hear ya.
I think a lot of people are looking forward to that.
Yeah, absolutely.
Do you ever think about, you know, potentially changing to an independent, or over concerns about the national role of the political party, or questions about Republican Party identification when you're going out and meeting voters?
I don't have to think about it right now. You know, I get to run as a nonpartisan elected official, which is really special and allows me a lot of room. I will say I've always been a Republican and a conservative. I've worked for Republicans. The conservative ideals are something I really hold dear and important, are kind of how I govern. But at the same time, I maybe y'all don't know this about me. I was raised in a really small town in Texas where you just take care of one another, and I try to lead with that first, open-minded approach in any kind of role. And so I just honestly don't have time to worry about it. And it sounds silly, but this job is full-time and then some, plus being a mom. And so I'm just not interested in being involved in partisan politics right now.
All right. No, and appreciate you weighing in on this. I want to go back to your city and what's kind of top of mind, because the U.S. Census has said you guys are the second fastest growing city in the United States, and you've certainly got into some of the reasons why with the inflow of people coming in, almost 330 every day, you say. So top of mind in terms of growth, you talk about infrastructure. Where do you want to spend money? Where do you want to spend your tax dollars on?
Yeah. So we're actually investing about $3.5 billion in mobility projects across Fort Worth and Tarrant County right now. And that's in partnership between the city, Tarrant County, our MPO, North Central Texas Council of Governments, and TxDOT. So I'm really proud of that planning process that started well before I was mayor and continues today. Is first and foremost. Of course, affordable housing across the region and kind of keep up with that growth, and different types of products for families across the area. And then educational opportunities, making sure we have high quality education from cradle all the way to career has always been a priority for me prior to being mayor, and that continues today.
What about when it comes to public safety? Because cities around the country are facing an issue that Fort Worth is also facing as well, rising homicide rates. And I'm wondering what specifically you're doing in order to bring crime down in Fort Worth.
So first of all, we're making the right investments in our police department. We are pro-police and pro-community at the same time. I'm really proud to tell you that we're adding 53 sworn officers in this year's budget that was just approved, along with about 20 civilian positions to support our police department. That's patrol division, but also in our police divisions, such as our CIT team, which is our crisis intervention team to help with mental health issues, our HOPE team with help with our homeless population. These investments matter. Also making sure we're really focused on recruitment and retaining top talent that deserve to be police officers in our city. We're very fortunate. We have a community that really appreciates our police officers, works alongside them, shows them how much we care and appreciate the work that they do on behalf of our residents. And that really shows up in how we're able to attract police officers into our cadet program. So all that holistically is focused on public safety. And the last thing I'll say is I'm not a police officer. I don't have the expertise of law enforcement. I have a very close relationship with our Chief Neil Noakes in our department, listening to his command staff and understanding what they need to fight violent crime, especially our homicide and aggravated assault rate that has continued to rise in the city. And I think we're going to be a real example for this country over the next year and what we're doing right.
All right, so Tim and I both have the same question. Go ahead, Tim.
Is it Mayor Maddie now, then Senator Maddie?
Or Senator?
Or Governor Maddie in the next 10 years?
Guys, I've got a 6-year-old, right? I'm just barely surviving. I'm more worried about, I forgot to order groceries yesterday, and I got to figure that out tonight, and what kind of costume we're going to wear for Halloween, right? You've all been there, exactly. So I'm pretty proud to be mayor of this city right now, and it's a dream job for sure.
But it's a long runway. I've got a lot of family in Texas. I'm going to start grilling them about you. No.
Okay, yeah, go for it. See what they say, and then let me know, Carol. I'm kind of curious what my reputation is.
No, I'm just really curious. But I mean, do you think about that politics? You're going to be in it for a long time?
Look, here's the thing. Our democracy is the reason this country exists. Freedom is not free, and I'm so proud to be an American and a Texan. And I think I get frustrated sometimes when it's so easy to be armchair quarterback and joke about our politicians or elected officials at all levels of government when it's incredibly important. It's literally how this country was founded. And so if I get to be an elected official and be mayor of a city like this, I'm pretty proud of that. What's next? Who knows? I may be tired of politics at some point and go back into the private sector. Or maybe I want to keep on this pathway, but I just need to do a good job for the residents of Fort Worth, and that's where I'm focused right now.
Mayor Parker, that 6-year-old eventually goes to high school, and then they don't want anything to do with you. I'm just going to tell you. I'm just kidding. Come back soon. Let us know how things are going. We would love to check in with you again. Maddie Parker, she's the mayor of Fort Worth, Texas, joining us via Zoom from Fort Worth, Texas.
Good show.
Yeah, great stuff. That's it, guys. Have a great evening.